Hi everyone, to continue our M&A series, in this video we're going to be discussing the Sale and Purchase Agreement, or SPA or SPNA depending on how you say it. So what is a Sale and Purchase Agreement? Well, it's a binding legal contract between two parties that obligates a transaction between a buyer and a seller. So what it is essentially a document, a very long document in practice, which a lawyer will prepare and the buyer and seller will both sign and execute. And this essentially makes the transaction binding. So everything that we've talked about in the previous videos and much, much more. So in terms of the calculation of purchase price, the completion mechanism, the adjustment for net debt and cash. And, we talk about these things at a high level and it's fairly straightforward when we talk about it, but actually putting it in writing, it becomes a very, very long document because the concern is that, from the lawyer's perspective is, can this be misinterpreted or can this be twisted in a way which wasn't intended? On top of that, there are a number of other issues which arise from a legal perspective which just haven't been discussed or thought of by the buyer and seller. So this ends up being quite a long process in terms of the negotiation of the SPNA, the signing and executing. And what typically happens when we get to this stage is that both parties who haven't quite equivocated that there's a number of items which they haven't considered, which are actually quite important and they actually disagree on. So because of these items, it can actually result in quite a lengthy delay at this stage. To avoid that, what you can do is to have quite upfront conversations with both legal teams quite early in the process and make sure that this forms part of the negotiation process along with the purchase price and other key terms, and not just left to the last minute because it can actually delay the transaction. So what are the key kind of components of a SPNA? So they define exactly what's being purchased. So, when you're buying a business, think about, what are you actually getting with it? Because you might not have discussed this. You have an idea in your head, I'm getting this business, but does that include the assets of the business? Does that include the customer list? Does that include the software? Does that include the proprietary IP? There's a whole number of considerations here once you start digging around the detail, which are very important. Also need to consider transaction structure. For example, the buyer and seller, the buyer might want to do an asset sale because it kind of de-risks it, because then you're only buying the assets of the business and not the actual entity that it comes with, and of course any kind of liabilities or contingent liabilities or risks that are linked to that entity. But from the seller's perspective, they might prefer a share sale because typically that results in a more favorable tax concessions for the seller. And then there's consideration, form of consideration, timing of consideration, conditions of consideration, and so forth. So if either party doesn't get what they think they bought or sold, the SPNA also provides protection mechanisms. For example, purchase price adjustments. So one example is the completion mechanism. So working capital is one aspect to that, which we covered in great detail in the last video. So, if we've agreed this is, the kind of the minimum gas that we need in the company, or aka the working capital of the company, and then on the date that we actually settle the business, that the working capital's fallen considerably because the sellers have stripped out cash or other things, then you actually get an adjustment to your purchase price here. So that's to protect the buyer. It also allows the buyer to actually get some money back if something goes wrong through representations, warranties, and indemnities. So we'll talk about these in detail, but essentially these are statements. So representation is a statement made by the seller saying, to the best of my knowledge, that there's no kind of fraud, there's no kind of misrepresentation of any of the numbers or statements. And warranties and indemnities are a section which essentially protects the buyer in certain instances. For example, if we buy the business and, all of a sudden there's this massive lawsuit which wasn't disclosed and wasn't picked up in FTD, you could essentially sue the sellers through the warranties and indemnities and actually hopefully get some money back through the court system. And then finally, the SPNA also provides protection mechanism to potentially terminate the deal. So the two kind of key areas here are conditions precedent and material adverse change. So conditions precedents are essentially if the seller or business doesn't meet these kind of set criteria, whether that's the transfer and approval of the leases across to you, or perhaps settling on one of the transactions that they promised that they'd do before settlement, you can actually terminate the deal. So the other side is material adverse change, or MAC clauses, and these are essentially clauses which say if there's a material change in the business, for example, maybe they lose their key customer or revenue kind of drops 50% before settlement, whilst you're still negotiating the deal, you can actually terminate the deal and you don't have to pay any kind of break fees or termination fees, which are typically quite heavy on a large deal. It could be in the millions of dollars. So why is an SPNA important? Well, this is just essentially a summary of kind of what we touched on the previous slide. So number one, it sets the price, puts it down in writing, including how that's comprised of, the upfront component, any earnout components, any clawback amounts, any completion amounts through the settlement accounts, etc. Number two is it seeks a purchase price mechanism. So these are kind of the clawbacks that we discussed. So that's the completion accounts that ensure a certain level of net working capital will remain in the business, and if there isn't, it's taken off the purchase price and put back in the business to retain that minimum level of net working capital. Number three, representations and warranties, just making sure that the seller states that all the numbers are correct, everything is to the best of my knowledge, I've disclosed everything material, etc. And then number four, indemnities. This helps protect the buyer in cases of any kind of adverse effect like lawsuits, penalties, tax liabilities which weren't disclosed and weren't found in FDD. So you can sue the seller through the court system if there's warranties and indemnities. The caveat to that, which I've mentioned in a previous video, is if you do find it in FDD, you can't use the warranties and indemnities because you were aware of it and you assumed the risk, plus you had the opportunity to adjust the purchase price for it at that point in time. The other caveat is if it is actually disclosed to you by the sellers, again, same story, you could have adjusted it or you could have walked away from the deal at that point in time. You were aware of the risk, so you can't actually sue under the warranties and indemnities in that point in time. And then finally, the MAC clauses, which we discussed before, which is the material adverse changes clauses. This is essentially if something goes wrong, revenue declines, something like COVID hits could fall under here. Just gives you a reason to potentially walk away from the deal and protect the buyer. So let's talk about kind of some of the components of the sale agreement or the SPNA and how that links into the enterprise to equity valuation, which we've talked about in earlier videos. So as you know so far, some of the key lessons we've picked up in the previous videos. Number one, we calculate a business on the enterprise value as a function of, it's EBITDA typically, but it could be of other measures. So it's typically a multiple of EBITDA. And we typically adjust the business for net debt and also for net working capital. And that gets to our equity value, which is the actual amount that we end up paying for the business. So this is we understand now why we do this, to make sure that, two businesses which are identical are actually adjusted in their purchase price if one business has more debt or one business has more cash. So as you know, we buy business on a debt-free, cash-free basis with normal levels of working capital. So that's the basis of any kind of M&A transaction. However, debt-free, cash-free doesn't actually mean that the business is acquired free of cash and debt. That's why we have mechanisms in place to just adjust the purchase price for that, where it's not practical to kind of pay out debt early, etc. So these are all kind of built into the SPNA and why we need the SPNA. So some of the key purchase price adjustments. So what are the purpose of purchase price adjustments? So the main ones being the net debt and also the completion accounts for net working capital, but potentially also could be a separate one for any kind of known CapEx spend as well. So what is the purpose? The purpose is to align the valuation basis, which is debt-free, cash-free, with normal level of working capital, with the actual net assets of the business to be acquired. So some of the functions that it does, as you know now, it adjusts the purchase price for the level of debt, ensures adequate working capital is acquired to run the business, and it protects against working capital strip pre-completion, and to ensure all budgeted CapEx is spent up to completion. So what are the things that can go wrong? So the mechanism in the agreement does not reflect the party's intentions or due diligence issues identified. So this is called a drafting error, and this is, you might have agreed a certain intention between one party or the other party or both parties combined, but then the way that the agreement actually reads might end up being a little bit different, whether that's due to miscommunication between the parties and the lawyer, misunderstanding by the lawyer, or failure to check a mistake on any parties. Then yes, that's called a drafting error. Another thing that can go wrong is items included in both the price adjustment mechanism and other adjustments such as cash and debt. So this is kind of a double up. For example, leave entitlements is an expense that's in the EBITDA, but also being included in net debt as well. And then items included aren't rigorously defined, so there's open to interpretation and therefore debate. Or finally, too complex, and the more complexity you add to the mechanisms and the formulas, etc., the more chance it can go wrong, could be misinterpreted, calculated incorrectly, etc. So finally, covering the risk. So awareness that the only rules that are those contained that in this SPNA, right? So if there's a gentleman agreement outside of the SPNA, it doesn't really matter. It's only what is in the SPNA is legally binding. So that needs to be the final document, be as airtight as possible. We need to ensure the definition of a price adjustment mechanism is as watertight as possible as well. So that's the most important aspect, is the actual purchase price calculation. So we need to make sure that there's no errors, there's no room for interpretation or misapplication. And then finally, working the mechanism through with the numbers. Does it work? So what you'll find with the SPNA calculations is they're often formula based, and it's drafted by lawyers who are often better with words than numbers. So it might look, the formula might look good on the surface, but then when you actually plug the numbers into the formula, have you checked that it actually flows through and works? So we've kind of covered this in the last video with working capital, but one of the key mechanisms that you'll find in the SPNA is the actual purchase price adjustment mechanism for working capital. And just to quickly recap what we covered in the working capital video is that any typical business for working capital, which we'll assume is this line here, a theoretical business, will have ebbs and flows subject to kind of timing, seasonality, and general recurring trends in the business. And the issue is we might do the analysis over here, let's say over here, and then we might determine that the normal working capital level at that point in time is $5 million, and then by the time we settle the deal, we calculate the working capital to be $9 million, which means there's a $4 million surplus, which means there's an adjustment to the purchase price of $4 million. So completion accounts is required per the SPNA to help kind of calculate those working capital adjustments, but it may also be used to calculate net debt as well if that's not done up front at the time of negotiation. So how the completion accounts are specified, defined, are also really important in the SPNA, because that's going to lead on to the interpretation and application and calculation. So the SPNA should set out the meaning of all terms used in the agreement that do not otherwise have an unambiguous common or legal meaning. Really important to have clarity on every term to avoid any misapplication or areas of non-transparency. So really important that they cover the accounting definitions. The reason being is, for example, how would you define a couple of these terms, right? Material, gap, cash, debt, working capital. If you just use general definitions like that, then obviously these are open to interpretation. For example, with gap, it's dependent on, early adoption of certain standards. What's the treatment of certain standards there? Jurisdiction. With cash, is it per the general ledger or is it per cash at bank? With debt, is it inclusive of tax, capital creditors, leases, and provisions? So there's kind of gray areas which may sit between kind of working capital and debt. Are they included in debt? And similar for working capital, like we just need very precise definitions and inclusions. So here's an example of some badly drafted clauses in SPNA, just showing you why it's so important to have very specific and correct definitions. So some badly drafted examples include stock that has not moved in 12 months shall not be valued, right? Because obviously the lawyers are thinking, okay, that's going to be obsolete stock. But for a lot of businesses, 12 months might be the normal kind of inventory turnover period, right? So if you've got that then you might be significantly undervaluing the net working capital. Next is the completion accounts are to be prepared in accordance with the accounting policies, and the accounting policies are those followed in the completion accounts. So there's a bit of a circular definition there with no specific definitions to what accounting policies actually are. Next, the balance sheet is true, fair and accurate, again, doesn't really mean anything at this point in time, especially when there's qualitative words like how can you ascertain that the accounts are fair. And then finally, warranty should be payable equal to 5% of profits. So how do you actually define what profits are? So you actually need a separate definition for that as well. So here's another specificity example where we've defined working capital. We've got two examples, one where it's a bad definition, one where it's a good definition, one which is just quite general, open to misinterpretation or misapplication, and one which is quite specific and is going to minimize kind of any disputes from both parties. So in the first example, we've got working capital should be determined in accordance with GAAP. So why is this a bad example? It's not specific. It doesn't tell us what should be included in working capital. And once we actually get to the time of completion, both parties are going to be arguing again as to the calculation of working capital. So in the second example on the right-hand side, we've got another situation where working capital, the definition says working capital is the aggregate of all line items marked A in the pro forma balance sheet above. So I've actually attached a balance sheet as a pro forma appendix. And the final working capital should be determined by the aggregation of the same line items from the completion balance sheet. So we've got a pro forma balance sheet above, and it's saying, apply these same line items to the final numbers given us in the completion balance sheet. And they've given us specific lines like inventory, trade receivables, trade payables. And if you're very specific about those, then you know exactly what to include, and there's no dispute at time of completion accounts. Here's another example of bad drafting that we want to avoid. The top one is a badly drafted example, and the bottom one is a better example of correct drafting. So the top one is saying we're defining completion accounts in the SPNA. So in this case, the completion accounts will be drawn up on the basis of those accounting policies which have been used historically in connection with the preparation of the accounts, and to which the best knowledge of the vendors are in accordance with GAAP. So the problem with this is that we're saying it's be prepared in accordance with how it's historically been prepared, but what happens if it hasn't been correctly prepared in accordance with GAAP or IFRS, depending on how the company's been reporting? Then the seller is not held accountable to any proper accounting standards. So if they've been accounting for things incorrectly all this time, then they're allowed to account for it for the purpose of the completion accounts. They could argue that, and they'd be correct because of the drafting of the completion accounts. So a good example is the unintended consequences that bad drafting can have. For example, they could have been accounting for revenue on a cash basis, and let's say that theoretically passed through financial due diligence and no one picked it up. The vendors could say, well, to the best of our knowledge, it was in accordance with GAAP, but it wasn't, right? And they could use that to then manipulate the outcome of the completion accounts, theoretically. So a better example wording is saying the completion accounts are to be prepared as follows. You've got a kind of a flowing hierarchy of standards. A, in accordance with the specific policy set out in Schedule X. So you can even set out specific accounting policies if you want. B, subject to Clause A, in accordance with the accounting policies adopted in the 2011 accounts. So that's then to be consistent with prior years. And then C, subject to clauses A and B in accordance with Australian GAAP or IFRS. So because they've given a hierarchy in this definition, the hierarchy is clear, and GAAP only becomes relevant in a circumstance not covered by a specific policy or specific accounts. Australian GAAP should be a defined term as well. So just make sure we've defined all the key terms here. So using the completion accounts again as an example, let's talk about in detail the key issues arising from each of those. So, and how we should be doing it. So we should be using precise and unambiguous wording and sufficient level of detail. We should remove the exercise of judgment, right? We need to just tell the reader how it is, not leave anything open to interpretation or judgment. So vendors should include a cutoff for post-balance events, right? Otherwise they can just keep dragging it forward. There needs to be a line in the sand when things are just included. And tend not to include consistently applied policies, as this can create confusion. Next, consistently with prior accounts. So issues can arise with reference to policies alone. For example, financial statements noted stock is to be valued at the lower end of cost and net realizable value. Company calculated this by applying a 50% provision to any stocks held for more than 6 months. Some of the issues with with the third hierarchy layer, which is just using gap, is precisely define, which jurisdiction, issued by which accounting body, at what date. So I guess, just to clarify, these are all relating to each of these kind of hierarchy levels. And I guess the point of this is just to show that even in a well-drafted document, there's still risk of misinterpretation, which is why these documents are so long, often many hundreds of pages, because kind of everything, we need to consider these questions. So even when we say specific policies here, we need to think, okay, well, what are the kind of issues, what are the kind of misinterpretation issues or any kind of judgment issues? Even when we say specific policies, that may still be too unambiguous. And when we say consistent with prior accounting policies, we need to say, well, were there potential issues with prior policies? And then for GAAP or IFRS, we need to say, IFRS, yes, but which jurisdiction? Is it IFRS in Australia? Is it IFRS in the United States? At what date? Because IFRS is constantly changing and evolving. So is it the most current one? And how do we approach kind of, early adopter policies as well? So just not definitive, but just an example of kind of the way you need to be thinking about these SPNAs, and also kind of explaining why they're so long. And the reason why we need to do this. So here are some of the kind of common pitfalls leading to SPNA disputes, which you can see why taking this kind of and applying this kind of thinking to SPNAs and problems and definitions can help avoid these pitfalls. So number one is inconsistency. Number two is complexity of subject matter, right? Potentially not being able to understand it or misapplying it, or maybe it was too complex and the lawyers didn't draft it correctly as a result. Subjectivity, so not being precise enough, and that leaves space for either party to interpret it a different way. Use of accounting jargon, which maybe doesn't have a correct definition or applied incorrectly, similar to complexity. Maybe time pressures, so if we need to settle a deal within X days or X months, that can maybe lead to some things being missed or key areas not being addressed in the SPNA. Poor definitions, so for example, some of these ones we might not have addressed some of these key issues arising from the definition, or maybe it's a circular definition like we showed earlier. Due diligence issues not reflected, so I mean if there's a kind of key issue either in legal, commercial, accounting, which has been raised, we need to figure out, has this actually been addressed in the SPNA as well? For example, a tax liability picked up in the tax due diligence, we need to make sure that this is reflected as a net debt item in the sale agreement, and make sure that there's strong warranties and indemnities to protect against similar issues that are not due diligenced. Parties' intentions not reflected. So this is essentially when, this is called a drafting error, and this is when, the lawyers have, both parties, both the buyer and seller have agreed on the terms, but then the lawyers haven't interpreted that correctly and they've drafted a different way, whether deliberately or accidentally. And then finally, advice not reflected. So we've been provided some advice and it's not actually reflected in the sale and purchase agreement. So here are some examples of some other common issues that have arisen in the past. So undefined terms. So there's been an agreement or provision where, here's an example here. So there's been no material adverse change in the company's financial position since the last audited accounts. But the issue in this situation is that material was not actually defined in the sale and purchase agreement. So how do you define material? How do you quantify that? Is it $1? Is it $1 million? Is it $1 billion, right? But by not defining that, you're then leaving both parties open to dispute when something like this actually arises. And of course, the buyer and seller are both going to argue the side that suits them. The seller could argue, well, we interpret material to be $1 billion and, you only had a $1 million loss, therefore it doesn't satisfy this this provision, and the other party's going to have the adverse view, right? So we just need to be as specific as possible and think about these issues. So the next example of issue we've come across is an interaction of agreement clauses. So an example of this occurring in the past, which is the completion accounts that to be prepared in accordance with accounting policies, and the accounting policies are those policies defined in the completion accounts. So there's two separate definitions in the agreement, and as you can see, there's a circular definition without actually providing an actual definition. Just refers back to a different section, right? The problem, of course, is we now don't have a definition, and we're in the same boat as if it was defined not specifically. We just now have an open-ended definition. The next issue is around terminology that we've come across. So the agreement example of this was loss means any loss, including any damage, claim, action, liability, cost, expense, charge, penalty, outgoing or payments, and legal costs and expenses on a full indemnity basis. So the problem with using all these terms is we did use legal and accounting terminology, but each term was not separately defined. And it's also not clear as to whether these are mutually exclusive or codependent. In other words, do all of these things have to happen at the same time? Or is it any of these could occur for this to trigger this particular clause? We also don't know if the amounts we're referring to in terms of these losses and indemnities, etc., and payments, are they on an accrued basis or a cash paid basis? Because, when we actually get to the claims basis, it's going to change the dollar amount depending on whether it's accrued or cash. So that's why it's super important to have very specific definitions everywhere. Next is unrealistic warranties. So, for example, the balance sheet is true, fair, and accurate. So it's almost certain to breach the accuracy clause, right? And fair is a kind of, very open-ended and subjective view as well. So it's an unrealistic warranty. Can't expect the seller to sign up for this necessarily because they can't say it's completely accurate. Next is, does the language reflect the intention of the party? So this is a common issue in sale agreements where it's a drafting issue where the language in the sale document, which is often very technical language, and the seller and buyer might not actually understand it, it might not actually reflect their intention. So an example here is the revenues were defined in terms of cash accounting, the costs were defined in terms of accrual accounting, and the earnout provision was a function of an agreed EBITDA multiple and profits, which is revenue less cost. So the problem was the business experienced rapid growth, the cash revenues were material less than accrual revenues, and the profits were SP&A were material less than accounting profits because of how they defined cash versus accrual on two different terms. So here's some more detailed examples. So one is one-sided accounting policies. So for example, no accruals or provisions are released or reduced except for cash payments or utilizations for which provisions were originally established. For the avoidance of doubt, does not include credit to the profit and loss statement. So the problem was the tax payable. So the tax return finalized before completion, the vendor could not release provision, and the purchase got a free ride of $500,000. Next issue is undefined accounting term. So an agreement provided for a payment of royalties of 5% of profit for 3 years period. However, the word profit wasn't actually defined in the sale agreement. So the company increased the depreciation rate on the P&E to the extent that they didn't actually make an accounting profit. So if it was defined on cash EBITDA or EBITDA, they would have paid out a significant amount of money, but it's been able to be manipulated because they just changed an accounting rate and therefore mitigate any royalty payable. And then finally, we've got inappropriate or impractical adjustments to earnings for an earn-out mechanism. So we could have an open-ended clause saying something like the EBITDA will be adjusted for quality and sustainability, and the earnings shall be adjusted if the business is underfunded. So, there's a number of issues arising from this because it's so open-ended and not specifically defined, it then leads the buyer to then manipulate that and put in essentially any normalization they want to because it comes under quality and sustainability, which are not defined in very broad terms. Okay, now locked box approach. So let's talk about this. So this is another way of approaching sale and purchases of businesses, and it's different from the standard approach with a working capital adjustment at the time of completion. So typically how that works is the normal approach is you agree on a business. So let's say you do due diligence in October, right? October 2021. Now, because it's a large company and due diligence takes a long time and you go through all the sale agreement, etc., let's say you do all that process, the due diligence, the sale agreement, the negotiations, etc., and it takes you, let's say, until, April the following year to actually settle the deal, so sign and pay for it. In between, it's all the negotiation, the FDD, the due diligence, the lawyers, the insurance, all that stuff, the integration planning, approvals, right? These large transactions take a very long time sometimes. And then a completion account, that's 6 months later, there's probably going to be quite a material change in the business, and you do a new balance sheet at the date of completion, and that's your kind of completion accounts. So that's how most transactions are done. However, there are many situations where that arrangement cannot be done. And a very common example where it cannot be done is where there's a a public to private transaction, where it's essentially a listed company which is being taken private through a scheme of arrangements. And the reason you can't do that normal completion account mechanism is because the people that you are buying the business from are individual shareholders. So you're dealing with, thousands, hundreds of thousands, even millions of individual shareholders. So you can't really do a completion accounts 6 months after the fact, because you either propose a single share price per share and pay out to the shareholders, and that's it. You can't just then claim additional money through the completion accounts later on, or do a net debt adjustment later on. You can't do that. So how we approach transactions like that, and you can also do this in a private transaction environment where you just don't want to deal with the inherent uncertainties in predicting the shape of the business balance sheet at completion. So maybe you just want to avoid that risk. You just want to do a single payment purchase, and that's it. So this is called a locked box approach. So how this works is it involves the vendor providing and generally warranting a balance sheet for the business being sold at a point in time before signing. So in the example I gave you before, we'd have a business and it would just be at, say, the October period, I think I said it was. So at that point in time, you just calculate the balance sheet at that point in time, you do negotiations, you settle the business based on that, you factor in your net debt at that date, you factor in your earnings at that date, and you factor in any working capital adjustment at that date, and that is it. It all bundles into a single payment, and that's the final and only payment you make. So that's the locked box approach. So there's a number of pros and cons to this. The pros is obviously simplicity, and some transactions it's the only way you can do it. For example, the public to private. The cons is, if there is a large, movement in the business, and that may be favorable to the buyer or seller, it's often favorable to the buyer because in those, let's say it's 6 months to completion, the business is going to be accruing a whole lot of cash, and that cash won't actually be factored into the lockbox negotiation because, as I said before, it was settled at October, but we're completing 6 months later, so any cash is just going to go to the benefit of the buyer. But it could go the other way as well, right? There could be changes in the business in those 6 months, which might actually result in a significant decline in the business, but then of course you've still got your material adverse change clause, which you can then potentially walk away from the deal. So I would say locked box approaches generally favor the buyer. So here's a very basic visualization of how that might work. So in this example, and forgive me for the old dates, so in this example, the purchase price calculation is based on the most historical figures. So in this example, we're saying, okay, let's just going to do all the due diligence and deal at 31 December. That's our line in the sand. So we're going to use the most recent financial information. We're going to use the net debt figure at that point, and we're going to calculate our net working capital at that point in time. However, we don't exchange and complete the deal until much later. So in this example, we're not exchanging till March the next year, so that's 3 months later, and we're not completing until another month, so 4 months after the initial exchange date when the cash is exchanged. Typically, I think in most transactions you'll actually do these on the same date, but we've just split it out so you can actually see the different processes for the actual signing and exchanging of the sale agreement versus the actual payment. But in practice, this is often done at the exact same time. So as I mentioned before, you do all your calculation over here and you complete over here, and there's no adjustment at these later date, and any upside or downside is just assumed by the buyer. So what are the advantages and risks of the locked box mechanism? So let's look at it from the purchaser's perspective. So the advantages for the purchaser, so number one, competitive advantage. It will be attractive to the vendor, so you can probably, if you're competing with other bids from other buyers to secure the deal, maybe you can get this over the line because it just packages everything up and there's no uncertainty. The next advantage is on that it provides a very high level of certainty. So you know what the normal and actual level of working capital is, you know what the net debt is, and it's all factored into a single purchase price and no further payments. Another advantage is speed. So historical results are readily available. It's all ready to go. You can settle the deal probably a lot quicker. So the risks for the purchaser on the other side is there is an opportunity lost to obtain price reduction through completion accounts mechanism. So as I said before, if there is a downside to the business in the next 3 to 4 months in that example earlier, normally you would just do a downward adjustment to the purchase price through the completion accounts mechanism. However, with the locked box, you're already signing that up, so you don't get any downside. On the flip side, you do get the benefit of any upside in between the time as well, so it kind of evens out there. Another risk is there's less time available to examine the effective date balance sheet compared to full completion accounts review. Next is management accounting records still under the vendor's control, as opposed to completion accounts, which is under the buyer's control. So maybe you're a little bit more comfortable with the completion accounts because you know you've prepared them, as opposed to we don't really have a good view of the vendor's processes of control and whether they're trying to sneak one under that we're not aware of. We also need to watch out for intercompany transactions in the accounts as well, which obviously probably wouldn't be an issue post-completion if it was under the buyer's accounts. And then finally, the vendor's obligations need to be carefully drafted to protect the purchaser. Okay, now what about from the vendor's perspective, aka the seller? So the advantages for the vendor, so speed and minimizes vendor time. You don't need to worry about completion accounts later on. So there's no completion accounts process, so it makes the whole sale process in totality a whole lot simpler. Perceived higher headline price for the business. So at the end of the day, obviously it doesn't actually change the purchase price, but if you're moving more of the completion account adjustment into the headline price and you're moving the net debt adjustment into the headline price, it looks like you got a better deal for the business. So maybe if you're a seller, you can report to your shareholders, your investors, and say, look, I got a higher price for the business. We know that it probably would have evened out over time anyway, but it just tells a better story, might be perceived as a more attractive, favorable structure by the vendor. And also finally, certainty of purchase price at exchange. So yes, if you have a completion accounts mechanism, you do have a certain level of certainty around your purchase price from your headline price, but at the end of the day, it's still at the back of your mind, could I have a large negative downward adjustment to my purchase price from the completion accounts? And just to close this off, some other important features we should be aware of. So you need to ensure that you have received the appropriate protection from effective date through to exchange and completion. And this includes value leakages, warranties and undertakings, as well as warranties on the effective date balances. And in addition, you need to be able to successfully implement the structure. You would need to be granted a good level of access to the effective date balance sheet. So again, coming back to the issue of, the buyer typically prepares the completion accounts because the business would be in their hands at that point in time. But because under the lockbox mechanism, if the seller is preparing all of the accounts, it's important, probably even more important than usual, that the seller also gets a good level of access to the effective date balance sheet. And that includes the controls, the processes, consolidation adjustments, like the underlying transactions, etc. Okay, so that's the end of the chapter discussing SPNA. I guess the key, at the end of the day, it might not seem like a key issue because all it is you've done all the hard work negotiating a deal, agreeing the deal, putting the terms together with the other party. You then give it to your lawyers. But as you've seen in this chapter, a lot can go wrong if you don't actually pay it the proper attention. And all your hard work agreeing certain terms could go out the window if your issues aren't addressed clearly, and if the lawyers haven't actually interpreted it correctly, or there's certain drafting issues within it. So really important that we understand all the possible issues that arise so that we're across that and we can help mitigate that by involving the lawyers early and being across the issues and looking out for them as we review those sale agreements. So hopefully you found that useful. Thanks for watching.